Most late starters that I talk with dramatically underestimate where they actually rank. The number that puts you in the top 10% of households near retirement is lower than many people think, and the gap to the top 5% and 1% tells a different story than the average headline suggests. So if you're in your 40s, your 50s, your early 60s, you feel behind, you've probably seen the big averages, the household net worth of $1 million plus, and you felt the pressure, right? Those averages are pulled higher by a small number of very high net worth households. So the median and the percentile thresholds give a clearer picture of where most people actually stand. So today I'm going to be walking you through the Federal Reserve Survey of Consumer Finances data, the most reliable source we have, and I'm going to show you what it takes to reach the top 10%, 5%, 1% as a late starter. So we're going to be looking at the overall numbers and, more importantly, the age group numbers, right, that matter for people in their 50s, 60s. So then we're going to be talking about what the numbers do and don't mean for building a workable retirement plan. So this is not about chasing a ranking. It's about understanding the landscape so you can make clearer decisions about where to put your effort. So, according to the most recent full survey of consumer finances data, the 2022 wave, which is still the latest comprehensive release as of mid-26, overall U.S. household median net worth sits at around 193,000. Okay, that's the 50th percentile, meaning that half of households have more, half have less. The 90th percentile, which is the start of the top 10%, comes in near 1.9 million. The 95th percentile, which is roughly the top 5%, is around 3.8 million. The top 1% threshold sits near 13.7 million. So these are household figures that include primary residence equity, retirement accounts, other investments, business interests, subtracting the debt. Averages run much higher, over $1 million, because the top of the distribution is so skewed. They show where the bulk of households actually cluster. So net worth rises with age for most households as incomes peak, mortgages get paid down, and retirement accounts compound. So comparing yourself to the all ages medium or the all ages top 10% can be misleading if you're 58 or 62. So here's the clearer age group picture from the same Federal Reserve data. Okay, let's look at this. For households headed by somebody aged 55 to 64, median net worth is roughly $364,000, $365,000. The 90th percentile, which is the top 10%, is approximately 2.9 to 3 million. The top 1% threshold is in the mid-teens of millions. Now let's take a look for ages 65 to 74. Median's about 410,000. The 90th percentile holds near around 3.3 million. The top 1% threshold climbs even higher still, into the high teens or low 20s of millions in some analysis of the microdata. Now, these numbers include home equity. So for many households, the primary residence is a large share of net worth. Liquid investable assets, retirement accounts, brokerage, cash equivalents are often lower than the headline net worth figure. Now, if you're a late starter in your 50s or early 60s, the median for your age group is still under 400,000. So reaching the top 10% for your age group requires roughly 3 million in total net worth. Now, that's a meaningful number, but it's not the 5 million or 10 million figure some people assume is required just to feel secure. Of course, every situation plays out a little differently, so it's always smart to run the numbers with your own advisor before moving forward. A household in the top 10% near retirement often has a combination of paid down or low mortgage home equity, sizable retirement accounts, and some additional assets. Many also have business interests or real estate beyond the primary residence. The path is rarely a single lucky investment. More often it's a consistent saving over decades, some home price appreciation, and limited high interest debt. For late starters, the realistic question is not, how do I jump to the top 1%? Rather, it's, how do I move from the median or below to a more secure position, right, but still having years of earning power left? The gap between medium and the 90th percentile is a large one. So closing even part of that gap in the next 8 to 12 years can meaningfully change retirement options. Now, that's where focused strategies matter more than hoping for average market returns alone. Now, the top 5% threshold sits near 3.8 million overall and higher in the older age bands. The top 1% requires roughly 13, 14 million overall and higher still for households in their 60s. At those levels, a business ownership, concentrated real estate, or long compounding of substantial capital becomes common. W-2 saving alone rarely produces top 1% outcomes without unusually high income or an earlier start. So for most late starters, the practical focus belongs lower on the distribution. Moving from the 40th or 50th percentile into the 70th or 80th for your age group already expands options significantly more. More flexibility on Social Security timing, more ability to cover healthcare gaps, more capacity to handle sequence of returns risk. Net worth is a snapshot. It doesn't measure the reliability of income streams, the tax character of assets, or how well the money is positioned for withdrawals. A household with $800,000 in a paid-off house and a couple $100,000 in retirement accounts, has a different retirement profile than one with, say, $400,000 right in a house and $600,000 in diversified tax-efficient accounts. Liquidity and cash flow reliability matter as much as the headline number. Inflation, healthcare costs, and longevity also change the picture. A net worth that looks solid in 2019, say, can feel tighter after several years of higher prices. Conversely, households that kept contributing and stayed invested right through the recent market years often improve their relative position. If your current net worth sits near or below the median for your age, several levers still work. First, maximize the remaining high-earning years. Catch-up contributions to 401ks and IRAs after age 50 are meaningful. Reducing lifestyle creep so that more of any raise or bonus goes into assets rather than spending accelerates your progress. Secondly, pay attention to the tax side. Partial Roth conversions in lower income years, careful management of capital gains, and coordination with Social Security can preserve more of what you've already built. The multi-year window before required minimum distribution begins is especially valuable for late starters. Third, consider how secured alternative income can reduce the pressure on the investment portfolio. Seller finance notes, for example, can produce monthly cash flow backed by real estate. Now, in situations that I've seen, late starters have used note brokering or small note purchases to create an additional income layer that lowers the withdrawal rate required from stocks and bonds. Now, this approach has worked well for folks in similar spots, though keep in mind your results could vary. Chatting with qualified professionals is the best way, really, to make sure it lines up with your goals. The point is not to replace traditional assets, to layer something with different risk characteristics so that the overall plan is more resilient. Fourth, you want to run the numbers on actual spending needs rather than abstract target net worth figures. Many late starters discover that a lower withdrawal rate combined with one or two reliable income sources produces more security than simply chasing a higher net worth number. Comparing yourself only to the top 1% or even the top 10% can be discouraging if the gap looks large. So a more useful comparison is your own trajectory. Where were you 5 years ago? What's a realistic 5-year improvement given your remaining years and current savings rate? I watched people in their mid-50s move from below median to solidly above median positions by treating the remaining work years as a focused accumulation window, rather than assuming the gap was permanent. Consistency compounds. So does reducing high interest debt and avoiding large lifestyle increases. The data also shows that many households reach peak net worth in the 65 to 74 age band and then gradually draw it down. So entering that period with a higher percentile rank gives more options and more margin for error. So here's a simple way to use this information. Calculate your current household net worth the same way the Federal Reserve does. Assets minus liabilities, including home equity, paired to the median and 90th percentile figures for your age band. And then ask two questions. One, What is the realistic target for the next 5 to 7 years that would improve my position meaningfully without requiring extreme risk? 2. Which combination of higher savings rate, tax efficiency, debt reduction, and additional income layers moves me toward that target most efficiently? The answers will differ for every household. Some will emphasize maximizing workplace retirement plans. Others will find that a secured income stream or a carefully chosen alternative asset does more to stabilize the plan. The percentile data simply gives context that the plan is grounded rather than aspirational. I remember looking at similar numbers several years ago, and I felt the weight of the gap shifting from a question I asked myself, I need to catch the top group, to I need a plan that works for my timeline and risk tolerance. It made the steps clearer. So you're probably further along than you think, as opposed to the average headlines, right, make you feel. So if you want practical resources on building additional income layers that fit late starter realities, take a look at noteinvestors.com. There's a link down below. Whether you're exploring leads for opportunities or considering the broker program, small, consistent steps tend to compound. The upcoming Note Investing Formulas material is going to go deeper into the specific calculations most people find useful. Okay, thanks for watching. If this clarified where you stand or raised questions about your own numbers, leave a comment below with the age range you're targeting. In the next video, we're going to be digging into specific strategies that help close gaps without relying on perfect market timing. You've got this. I'll see you in the next one.